Hey, let me ask you something simple. What if I told you that the way you're using your credit card right now might not just be costing you interest, but could also be creating IRS problems you never even thought about? Most people would laugh that off. Some would scroll away. Others would think, that sounds exaggerated. But here's the truth most people discover too late: credit cards themselves are not the problem. The real issue is what happens after you swipe them, how your spending gets reported, how your debt gets handled, and how certain transactions can quietly trigger tax consequences, reporting requirements, or financial red flags that most people never read about. And that's where things start to get serious. Because while there is no secret Supreme Court ruling changing credit card laws overnight, there are real federal tax rules, real IRS reporting systems, and real financial thresholds that can turn everyday spending into something far more complicated than people expect. So in this script, I'm going to walk you through everything you need to understand in plain English. No confusing legal jargon. No scare tactics. Just real-world financial clarity about what actually happens behind the scenes when you use credit cards in America, and why so many people unknowingly make mistakes that can lead to IRS attention, financial stress, or long-term debt cycles. Now let's start from the beginning. Credit cards feel simple. You swipe. You buy. You pay later. That simplicity is the trap. Because behind every swipe is a digital record, and behind every record is a financial system that tracks patterns, income, spending behavior, and reporting obligations. Most people think credit cards are just private tools between them and the bank. But in reality, credit card usage is part of a massive reporting ecosystem involving banks, payment processors, and sometimes tax authorities. And that's where IRS-related concerns can come into play, not because the IRS is watching every purchase you make, but because certain financial situations must be reported by institutions, not individuals. For example, if you run a business and accept payments through cards, those transactions can be reported through third-party settlement systems. If you receive refunds, chargebacks, or merchant settlements, those can generate formal documents that may be shared with the IRS during tax filing season. And if your spending patterns don't match your declared income, that's where questions can arise, not automatically, but potentially during audits or financial reviews. Now let's talk about something most people never think about. Debt forgiveness. This is one of the biggest hidden tax triggers tied indirectly to credit cards. If you fall behind on credit card payments and a lender eventually settles your debt for less than what you owe, the forgiven amount can sometimes be considered taxable income. Yes, you heard that right. If a bank forgives part of your credit card debt, the IRS may treat that forgiven amount as income in certain cases, which could require reporting and potentially increase your tax bill. Most people only realize this after receiving a tax form they weren't expecting. And that's where financial shock usually happens, not because anything illegal occurred, but because people didn't understand how debt settlement is classified under tax rules. Now let's slow down and make something very clear. Using a credit card is not illegal. Owning debt is not a crime. But misunderstanding financial reporting rules is what leads to problems. So when viral videos claim things like "stop using your credit card because of an IRS rule," they're usually taking a small piece of truth and turning it into fear-based storytelling. The real issue is not usage, it's awareness. Now let's talk about another real-world factor: business expenses. If you're self-employed, freelancing, or running a small business, your credit card becomes part of your financial documentation. Every purchase you make can potentially fall into one of two categories: personal expense or business expense. And mixing those without proper tracking is one of the most common tax mistakes in the world. Why? Because during tax filing, business owners are expected to report income and deduct legitimate expenses. If your credit card shows unclear or mixed spending, it becomes difficult to accurately separate deductible expenses from personal ones. This doesn't automatically trigger IRS action, but it can create inconsistencies that may require explanation if your return is reviewed. And here's where many people get caught off guard. It's not the big purchases that cause trouble. It's the pattern. Consistent mismatches between income and spending. Unexplained transactions. Repeated large cash advances. Or sudden spikes in credit usage that don't align with declared earnings. These are the kinds of financial signals that can raise questions in audits, not accusations, but questions that require documentation. Now let's shift into something even more important: cash advances and taxable implications. When you take a cash advance from a credit card, it is not income. That's a common misconception. It is debt. However, the way you use that cash and how it moves through your financial system can indirectly affect your tax situation if it's tied to business activity, unreported income, or inconsistent financial records. Again, the IRS doesn't care that you used a credit card. It cares whether your financial records are consistent, transparent, and properly reported. Now let's talk about something emotional for a moment. Debt stress. Because most people don't get into trouble with credit cards because they are irresponsible. They get into trouble because credit cards make spending feel disconnected from reality. You don't see the money leave your hand. You don't feel the loss immediately. And by the time the bill arrives, you're already behind. That's how balances grow quietly. $200 becomes $2,000. $2,000 becomes $20,000. And suddenly, minimum payments no longer make a dent. At that stage, people start exploring settlement options, hardship programs, or forgiveness arrangements, which brings us right back to IRS reporting rules again. Because once debt is forgiven, it may become taxable in certain situations through forms like cancellation of debt reporting. This is where financial literacy becomes critical. Not fear. Not panic. Just understanding. Now let's address something very directly. There is no law that says you should stop using credit cards entirely because of the IRS. In fact, credit cards are widely used financial tools that help build credit history, enable transactions, provide fraud protection, and support business operations. But like any tool, misuse creates consequences. The real message behind viral claims like the one in the title is usually this: people are unaware of how credit card debt, reporting, and tax systems interact. So instead of stop using credit cards, the correct message is: use credit cards with awareness, documentation, and financial discipline. Now let's go deeper into how banks and reporting systems actually work. Every credit card transaction passes through a network that records merchant category codes, transaction amounts, timestamps, and location data. These records are primarily used for fraud prevention, dispute resolution, and financial reporting. In normal personal use, this data stays between you and your bank. But in certain situations, like business accounts, tax reporting for contractors, or large-scale financial activity, aggregated data may be used to generate official tax documents such as 1099 forms or merchant summaries. Again, this is not about surveillance, it's about financial reporting obligations that exist in the banking system. Now let's talk about audits, because this is what most people actually fear when they hear IRS. An audit is not random punishment. It is a review process that happens when financial information needs clarification. Credit card data alone does not trigger audits. But mismatched reporting, missing income declarations, unusually high deductions, or inconsistent financial records can increase the chances of review. So if your credit card statements tell one financial story and your tax return tells another, that's when questions arise. Not accusations. Questions. And those questions require documentation. Now let's bring this into real life. Imagine someone earning a modest income but consistently spending far beyond their declared earnings using multiple credit cards. From a bank's perspective, that might look like debt accumulation. From a tax perspective, it might raise questions about income sources during a formal review. Not automatically. Not immediately. But potentially if other financial flags exist. This is why financial alignment matters. Your income, spending, savings, and reporting should tell the same story. Now let's talk about a major misconception people have. Many believe that credit card companies report your purchases to the IRS. They do not report your individual purchases. However, they may report certain financial summaries in specific situations, especially for business-related accounts or third-party settlement platforms. That distinction matters a lot. Because fear-based content often implies constant surveillance, which is not accurate. The reality is more structured, less dramatic, but still important. Now let's talk about protection. One of the strongest advantages of credit cards is fraud protection. If someone steals your card or makes unauthorized purchases, you are generally protected under federal regulations that limit your liability. That is a major reason credit cards are safer than debit cards for many transactions. But protection doesn't eliminate responsibility. You still need to monitor statements, track spending, and manage balances. Because financial systems are not just about spending, they are about accountability. Now let's return to the core idea of this script. Why do viral titles like this spread so quickly? Because they combine three powerful triggers: authority, Supreme Court; fear, IRS rules; urgency, stop using your credit card. But real financial truth is rarely that simple. Real financial truth looks like this. Understand your credit card usage. Track your spending. Avoid unmanageable debt. Know how debt forgiveness is taxed in some cases. Separate business and personal expenses. Keep records consistent for tax purposes. And stay informed, not scared. Now let's go even deeper into practical guidance. If you want to use credit cards safely in a way that avoids IRS-related complications and financial stress, here's what actually matters in real life. First, always know your monthly balance, not just your minimum payment. Minimum payments are designed to keep you in debt longer, not to free you from it. Second, never rely on credit cards as emergency income. They are borrowed money, not earned money. Third, if you are self-employed, use separate cards for business and personal spending. This alone can save you from massive tax confusion later. Fourth, keep documentation of major expenses. Receipts, invoices, and statements matter during tax filing. Fifth, understand debt settlement consequences before agreeing to forgiveness programs. Sometimes relief comes with tax reporting obligations. And finally, always treat credit as a tool, not a lifestyle extension. Because the moment credit replaces income in your mind, financial imbalance begins. Now let's bring this back full circle. There is no hidden Supreme Court decision banning credit cards. There is no secret IRS rule telling people to stop using them. But there is a real system of financial reporting, debt classification, and tax treatment that every credit card user should understand. And the people who do understand it are the ones who avoid stress, avoid surprises, and stay financially stable over time. So instead of fear, take awareness. Instead of panic, take control. Because the truth is not that credit cards are dangerous. The truth is that ignorance about how they interact with financial systems is what creates problems. And once you understand that system clearly, you stop being controlled by confusion and start making decisions with confidence. And that is the real lesson behind every viral financial warning you see online. Not fear. Not headlines. But understanding how money actually moves, how debt actually behaves, and how your financial life is shaped by the choices you make every day with a simple piece of plastic in your wallet.